All right, let's talk about it. We're at the end of a fantastic year in the markets, and that brings up a classic, high-stakes question for pretty much every single investor. What do you do now? So you've had an amazing run. Your portfolio is looking great. What's the move? Do you bet on that momentum continuing and just let it all ride into the new year? Or do you play it a little safer and take some of those hard-earned profits off the table? This is the big dilemma we're going to unpack. And what makes this so incredibly tough is that there is no single right answer. Even the seasoned pros, the analysts and fund managers who live and breathe this stuff are looking at the exact same data and coming to completely opposite conclusions. So let's dig into why this is such a head-scratcher. The main reason? Well, the market itself seems to be telling us two totally different stories at the same time. Just take a look at this. On one side, you have an economy that's absolutely on fire. Q3 GDP grew at a blistering 4.3%. Fantastic, right? But at the exact same time, the November jobs report showed unemployment ticking up to 4.6%. So, wait a minute. The economy is growing, but it's not really adding jobs? That's a huge contradiction. And you see the same kind of conflict in how investors are feeling. Stocks are hitting record highs, which feels amazing, but the VIX, which is basically the market's fear gauge, is snoozing near its lowest level of the entire year. Now, high confidence sounds great, but it can also be a massive red flag for complacency, a sign that maybe, just maybe, nobody is prepared for a sudden shock. And just to be clear, think of the VIX as a turbulence forecast for the market. When it's low, like it is right now, it means everyone is expecting smooth sailing ahead. But we all know that when everyone feels overly confident, that's often when the market is most vulnerable. Okay, so with that messy, conflicting picture as our backdrop, let's look at the first playbook. This is the argument from the camp that says, don't panic, stay the course, and trust the bigger trend. This quote really just nails their entire mindset. The idea here is that you've got to look past all the short-term, day-to-day noise. The really big picture, the long-term trend, is still pointing up. You shouldn't let a few weird data points from a sleepy holiday trading week shake you out of a winning game. So here's the bottom line for this argument. When you zoom out and look at the weekly and monthly charts, the signals are still firmly bullish. These folks believe that the end-of-year trading is super thin, there aren't many people making moves, and that often creates false alarms and fake-outs. Their strategy? Just ignore the static and trust that bigger, more powerful trend. Now let's flip the coin and hear from the other side of the debate. This is the camp that's making the case for being prudent, for managing your risk, and for locking in some of those incredible gains you've made. I absolutely love this phrase, reduce regret asymmetry. It sounds complicated, but it's really about a simple, powerful emotion, regret. The goal isn't to perfectly time the top of the market. The goal is to avoid the horrible feeling of watching a whole year's worth of gains just vanish in a correction. It's about which regret would feel worse. And the tactics here are actually pretty clever. By selling some of your winners, you do three things all at once. One, you lock in those profits. You turn paper gains into real cash in your account. Two, you build up dry powder. That's cash on the sidelines that you can use to pounce on the next great opportunity. And three, you're building a little bit of a shield for your portfolio, a cushion to protect you if the market does hit a rough patch. Okay, so we've got these two very different theories. But what does this stuff actually look like when you put it into practice? Let's make this real and see how you would actually execute each of these playbooks. To get there, we need to understand one key idea, beta. And honestly, the easiest way to think about it is as the gas pedal for your portfolio. A beta of 1 means you're just cruising along with the market. Anything above 1, you're stepping on the gas, getting more aggressive. And below 1, you're easing off, taking a more defensive ride. So in the example we're looking at, the portfolio starts with a beta of 1.36. That means it's already moderately aggressive. It's positioned to outperform the market when things are good, but it's also going to fall a bit harder when things turn sour. This is our starting line. And here is where it all comes together. The hold steady camp, they're keeping their foot on the gas. They're maintaining that beta right around 1.3 to 1.4. No big changes. But the de-risk camp, they're easing up. They're selling some of their more aggressive, leveraged assets and moving that cash into a safer spot, like short-term government bonds. And doing that brings our overall beta down to a much more defensive level, somewhere between 0.95 and 1.20. So after we've laid out both of these expert arguments, what's the final verdict? Well, the truth is, there isn't one. The correct playbook isn't decided by market signals. It's decided by you, by your own personal goals, and most importantly, your tolerance for risk. Because when you strip everything else away, it boils down to this really simple emotional trade off. What feeling would be worse for you? The fear of missing out, or FOMO, if the market keeps rallying without you, or the fear of giving back the incredible gains you've already made if the market suddenly turns south? And that's really the question we're left with. When you're standing at this crossroads with conflicting signals and divided experts, your answer to this one question might be the most important piece of data you have. It's what defines which playbook is truly the right one for you.